We're analyzing Adobe, stock ticker ADBE, to see if it's a great business on sale. We're using the Select 6 analysis to look at the most telling financial metrics before estimating an intrinsic value for Adobe. Then we're giving a final rating to the business. Before we get into these valuable metrics, let's understand Adobe's stock performance. Right now, Adobe trades for $479.51 per share. Their stock is crushing it year to date. They're up 42%. That's outpacing the S&P 500. In the last 5 years, Adobe's stock price is compounding at 14% annually. In the last 10 years, Adobe's compounding at 25% annually. Going back prior to the global financial crisis, Adobe's stock price is compounding at 15.5% for nearly the last 2 decades. This is far outpacing the market. Adobe's stock price is up more than 15 times over the last 2 decades alone. Adobe trades just $10 below their 52-week high. The company is up nearly $200 from their 52-week low. A little over 1% of their shares are sold short. Adobe is a huge business. They have a $218 billion market cap. But the burning question is, why should we be paying close attention to Adobe? Adobe provides content creation, document management, and digital marketing and advertising software. It operates through 3 segments: digital media, digital experience, and publishing and advertising. Adobe produces their Document Cloud, Creative Cloud, and Advertising Cloud offerings. Adobe traces its roots to 1982 and is headquartered in San Jose, California. With that background on the business, it's time to get into the numbers. Starting with metric number 1, we want Adobe's average 5-year free cash flow to be above 14%. The average publicly listed business earns about a 7% return on capital. Looking for a benchmark that's double this allows us to build in some margin of safety based off the quality of the business. Adobe's returns on capital have increased in all 5 of these years. They earned 32.5% returns on capital in their most recent fiscal year. Averaged out over this time, Adobe earns 26% returns on capital in a given year. That's nearly 4 times better than a typical business. This is a big check on metric number 1. We want to support their high returns with growth in their business. In metric number 2, we're looking for 5-year revenue, net income, and free cash flow growth. All 3 of these have to be up for this to be a check. This is all or nothing, and we'll be including up until today's numbers. In this time, Adobe's revenues have nearly doubled. Their earnings are up 82%, and their free cash flows have almost doubled as well. This is huge growth across the board for Adobe. Another check on metric number 2. Metric number 3, we're looking for earnings per share growth in the last 5 years. This looks at Adobe from the view of an individual shareholder in the company. Adobe's earnings are up 82% over this time, and they bought back 6% of their shares outstanding, likely a good sign for long-term shareholders. Through their earnings growth and their share buybacks, this is another check on metric number 3. Adobe has grown their earnings per share in the last 5 years. Metric number 4, we're looking for free cash flow per share growth over this time. A similar situation here. Adobe's free cash flows have nearly doubled, and with their small 6% share buybacks, this is another check on metric number 4. So far through our first 4 metrics, Adobe's a perfect 4 for 4 on our analysis. But there's still one vital piece missing. You might think nailing returns on capital and having good growth is the key, but we haven't touched on the one thing that I believe sets Adobe apart, which is having these characteristics without using a lot of debt. Metric number 5, we want Adobe's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow Adobe's produced in their last 5 years. Right now, Adobe has negative $1.5 billion worth of net debt, meaning they're sitting on about $1.5 billion of cash left over after paying off all their debts, and Adobe's been cash flow generative in all 5 of these years, increasing their cash flows each and every year over this time. Adobe's produced $27 billion worth of free cash flow. This is a huge check on metric number 5. Adobe is strongly cash flow generative, and they have this cash cushion. So far, Adobe's perfect through 5 metrics. Does the business have what it takes to be a perfect Select 6 stock? The big metric of them all, metric number 6, we want Adobe's average 5-year free cash flow divided by their enterprise value to give us a yield that's above 5%. If this is the case, this provides a slight risk premium to the yield of the 10-year treasury. It's the first of 2 different ways that we'll be valuing Adobe. Right now, Adobe has a $218 billion enterprise value. This accounts for both their net debt position and their market cap. It gives a perspective of Adobe similar to it being a private business. In the last 5 years, we learned Adobe produced $27 billion worth of free cash flow, meaning in an average year, they produce about $5.5 billion of free cash flow. When we divide that by their $218 $18 billion enterprise value, that gives us about a 2.5% average free cash flow to enterprise value yield. On a current basis, Adobe produced $7.3 billion of free cash flow in their last 12 months. When that's divided by their $218 billion enterprise value, that gives us about a 3.3% current free cash flow to enterprise value yield. Both of these yields are coming in below the yield of the 10-year treasury, meaning they're below that risk premium we'd be seeking. Coming in all the way on our final metric, this is our first and only X of the day on Adobe. Don't just throw this business out. We still need to come to a more concrete estimate of Adobe's fair value per share. Everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Adobe, which takes us on to using a discounted cash flow model to come to an estimate of their fair value per share. A DCF model is based off the predictability of a company's free cash flows. Like any model in any discipline, its outputs are sensitive to its inputs. Adobe's been a pretty predictable business in its past. We're starting with an average of their free cash flows from their 3 most recent fiscal years. Then we're using historical assumptions to grow these into the future. It's up to you to figure out if these are accurate or not for the business. Assuming they grow their 3-year average free cash flows at 14% for the next 10 years, then in the decade from there, this growth rate would be cut in half and they'd be growing these cash flows at 7% annually. If we add in the company's tangible book value, which gives an estimate of their net worth, if we're seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for in addition to his margin of safety requirements, at today's valuations, an estimate of Adobe's fair value per share is around $216. That's down more than $250 from their current stock price. Please be mindful of some key points. Adobe's been a very predictable business in its past. That's no guarantee for the future. This 15% discount rate is an estimate of total returns to shareholders based off their free cash flows. Also, their tangible book value just gives an estimate of their net worth. Adobe's business is high in intangibles and light in assets, so there are reasons that this could understate things. A big reason for the difference between their fair value and their stock price has to do with the multiples Adobe's currently trading at. It seems much of their price is coming from this run-up in their multiples. Most importantly, be mindful this analysis is not financial advice. It's not a buy or sell recommendation of any security. Consult with a financial advisor before making any investment decision. In just a minute, we'll talk about our final rating for Adobe. We've covered the numbers for Adobe, but the qualitative aspects of this business are just as important. What are they? Starting with the qualitative factors supporting a potential long thesis. Number 1, Adobe is extending its empire in the creative world from content creation to marketing services more broadly through the expansion of its digital experience segment. This segment should drive growth in the coming years. Number 2, shifts to subscriptions eliminates piracy and makes revenue recurring while removing the high upfront price for customers. Growth has accelerated and margins are expanding from the initial conversion inflection. Number 3, Adobe is the de facto standard in content creation software and PDF file editing, categories the company created and still dominates. We'd be remiss if we didn't cover the negative aspects of the business too, looking at the qualitative points supporting a potential short thesis. Number 1, digital experience has been built largely through acquisitions, including Magneto and Marketo in 2018. This raises the possibility of disruption from inadequate integration efforts and lends credence to concerns that Adobe may overpay for increasingly large deals. That's one of the big concerns around their potential acquisition of Figma, which is still undergoing regulatory review. Number 2, there's greater uncertainty in digital experience, given this is an emerging space and one that Adobe neither created nor dominates. Growth could be slower than anticipated, or margin expansion may not materialize. Number 3, momentum is slowing in Creative Cloud after elevated growth driven largely by the model's transition to software as a service. There you have it for a balanced perspective of some of the qualitative aspects of Adobe. Now it's time to give our rating to the business. In analyzing Adobe, stock ticker ADBE, Adobe's in the Pollen Capital portfolio, and it's also owned by Chuck Acre of Acre Capital Management. Both funds focus on long-term compounders, which it looks like Adobe has been. We learned the company has a lot of traits pointing toward it being a great business. They earn very high returns on capital. They've grown by a lot in the last 5 years while buying back 6% of their shares. The company's sitting on $1.5 billion worth of cash while generating increasing free cash flows in each of the last 5 years. It's worth reiterating this analysis isn't financial advice. The downsides for the business came when we looked at their valuations. Right now, the company doesn't look that attractive based off free cash flow to enterprise value yields. When we performed our discounted cash flow analysis, from today's multiples, if you believe those assumptions and want that 15% rate of return, it looks like an estimate of Adobe's fair value per share is around $216. That's a far cry from where the business trades today. Adobe was last at those prices back in spring of 2018. Looking at all the factors of our analysis, Adobe looks like a strong candidate for further research. Keep in mind this isn't a buy or sell recommendation of any security. Consult with a financial advisor before making any investment decision. If you enjoyed today's video, be sure to like the video, subscribe to the channel for more stock analysis videos, share your thoughts about Adobe, and let me know what business you want me to look at next in the comments below. Thanks for learning about Adobe with me, and have a great day.